As oil hovers around $80 a barrel mark, the Economic Affairs Secretary says that the government will ensure that there is no impact of oil prices on fiscal deficit, does admit that soaring oil prices will push up the import bill by about 20 billion this fiscal. Government remains non-committal on cutting excise duty to ease the burden of high oil prices. The government is watching the situation and adequate steps will be taken. Let's listen in.
ऑयल की सिचुएशन जो है ऑयल की प्राइसेस काफ़ी बढ़ गई हैं हमारी जो बास्केट होती है इंडियन बास्केट दैट हैज़ आल्सो गॉन अप इन लास्ट few weeks any increase in oil prices definitely has a lot of impact on our economy. So net impact of oil was about $70 billion last year. If the prices go up, obviously this will have impact. But under different scenarios, we see the impact ranging from roughly about $25 billion to maximum about $50 billion. The growth parameters are also extremely sound. Macroeconomic parameters continue to be very sound. The inflation is within the range of what we. So on the macroeconomic front, the economy continues to do well, and we have no sort of downward revision on growth or upward revision on fiscal deficit. So none of those things are worrying, despite whatever changes on the yield, etc., have taken place.
Because the problem really is that every tool that the government possesses, whether it is the government or the Reserve Bank of India, has a price. If you were to raise interest rates, there is a possibility that it could jeopardize a very nascent recovery that is happening. If the government were to cut excise duties, there is a possibility that it will hit revenues and thereby worsen the fiscal deficit. So oil prices going up combined with the depreciation of the rupee is always bad news for India. And as I said earlier, every tool has a price. We pay a cost, there is a cost. Yes, we might be able to contain it, but the government needs to be seriously concerned, and the very fact, as I said, that the DA Secretary felt the need to call for a conference means that the government is concerned, because I agree, even though our macro fundamentals are better than they were in 2013, they are nowhere near where they were about a year ago.
First of all, it's not clear that, oil prices will really sustain beyond 80 for an appreciable period of time. So, because Saudi Arabia could be worried about alternatives developing, and the long run view is that oil prices should soften. So some depreciation is good at this stage to encourage exports. And beyond that, there are various intervention tools available, large stock of reserves, and how to deal with focused demand for dollars. Last time they used that, supplying dollar swaps to oil marketing companies, which is very effective. So there are many tools the government has, and they will use them as appropriate.
Let's go across to my colleague Ruchi Bhatia. She attended at the press conference and filed this report earlier.
The rising crude oil prices has become a big concern for the government, while the DEA Secretary today did put up a brave front and said that they are looking at the situation very closely, and their strategy is ready for any kind of eventuality. One has to take into account that the rising crude oil prices, with crude oil almost at a 4-year high of close to $80 a barrel, will spell fresh troubles for the government's balance of payment situation, so much so that the government is expecting the trade bill on account of oil imports rising close to $25 to $50 billion per year, which means that last year, as compared to $110 billion of the entire trade bill, this will see a 50% jump. So clearly worries coming in on that account, and at a time like this, the government is also ruling out any sort of an excise duty cut, which means no relief coming in for consumers like you and I. It is of course important to note, while the government believes that they will not be cutting excise duty, because remember, every 1 rupee excise duty cut would mean the government foregoing close to 13,000 crore rupee in terms of their revenue. So the excise duty cut for that matter is completely ruled out at this stage. And as far as the government's own coffers are concerned, the balance of payment situation is sure to worsen from here, given the fact that the crude prices are rising. Exports are also not rising in tandem with that, which means that the trade deficit situation will balloon from here on. In fact, sources also telling us that if the crude prices stay at these levels for FY19, we may see trade deficit ballooning to close to $20 billion for FY19, and that will spell new worries for the government on the current account deficit front.